Ala, and let's take you through what's happening at an index level. While the Nifty 50 is up about 0.6%, you have a very robust show coming in from the broader end. Remember, lots of earnings, order wins, US FDA clearances, lots of brokerage reactions. There is so much at play when it comes to the broader end of the market, and you have a whole bunch of stocks like we were highlighting right now that are reacting to it. And on the back of this, the Nifty mid-cap and small-cap index are both seeing gains north of 1.5% and looking very solid on that front. But shifting focus, let's begin with the corporate conversations lined up on this show. And the first management that we're interacting with today is from CanFin Homes on the back of their Q4 earnings. Their net interest income has seen a little bit of a cut if you take a look at that on the year-on-year basis, but their NIMs are looking good. So let's take it across to the management and try and get a better sense on what the overall quarter shaped up to be like. And more importantly, what's the outlook going ahead? We have Mr. Suresh Iyer, the MD and CEO of the company, joining us on the show. Mr. Iyer, morning and thanks for your time. I want to start by talking about your assets under management. The AUM growth, that remains modest at about 10% on a year-on-year basis, despite the strong disbursements that we've seen this time around. If you could help us understand what are the key constraints and why isn't the disbursement translating into faster AUM growth?
On the absolute value terms, in fact, there has been a growth in the AUM, and it has also picked up from the previous year figure of 9%. However, basically the AUM comes with a little bit of a lag, and another factor which has slightly affected our AUM has been the higher prepayments. With slightly higher competitive intensity, particularly from the banks and some of the larger HFCs and NBFCs, there has been a little higher prepayment, which has been there for the last 3 quarters. So if you look at what we had, the prepayment in the first quarter, which was prepayment plus amortization put together, there has been almost about 200 crore higher. So from what we had projected of 12%, there has been an impact because of the prepayment of approximately 600 crores. However, in terms of the demand or in terms of the disbursement, it is very positive, and it's been a 23%, which we are likely to continue in FY27 also, because there is a good amount of demand, good amount of inquiries coming in. So basically, we are looking at the growth in terms of the disbursement continuing at a higher level. So going forward, slowly the AUM growths will also pick up.
All right, good to know about that. Mr. Iyer, morning, this is Shrishti also joining in, but let's talk about your NIMs. They have improved slightly on a sequential basis, but the yields and the spreads, they were seen to be moderating a bit. So going ahead, how do you see these factors impacting your margins, and how should one think about the margin trajectory?
In terms of the margin, we have maintained our margin, and for next year also, as against guidance of 2.75 spread and 3.75 margins, which we had given for FY26, we continue to have the same kind of guidance for this year as well. In fact, if you see our NIMs may have in absolute value impacted because we have passed on the rate cuts to the customers. So in the entire year last year, we have actually passed on 50 basis points cut to our existing as well as new customers. And that is the reason why our overall yields have come off. But at the same time, in terms of the borrowing cost also, it has come down. So our spreads during the year have improved, and we continue to have a spread of about 2.8 from the beginning of the year itself. So in terms of the NIM and spread, we will not have a problem. A spread of 2.8 and a NIM of 3.75 plus is what we are looking at going forward.
Okay, so that guidance is maintained, so that looks good. Also help us understand, Mr. Iyer, your asset quality, that also is continuing to improve with near zero credit cost. How sustainable is this level, if you could help us understand that? And are you seeing any early stress in specific borrower segments or geographies, maybe any risk to the asset quality at present?
Actually, in terms of our overall delinquency for the last 5 quarters, it has been coming down. And in terms of our overall NPA also, from 0.87, it has come down to 0.85. And going forward also, even in the month of April, we are not seeing much of a stress. So while there is a little bit of a talk of some stress in the building up in the low ticket value cases, but since our ticket sizes are about 25 lakh average, average ticket size is 25 lakh plus, and it's slightly inching up because of our segment also changing. So basically, we are not so far experiencing any impact on our delinquency or our check bounce or any of those parameters. So we continue to have a similar guidance for this year also, that a credit cost will not be more than 15 basis points. which actually in this year was about 10 basis points. So our guidance will continue as the same. We are quite confident there won't be much of an impact on our delinquency or NPAs.
But let's talk about the profit figure, Mr. Iyer, because this time around we have seen some of the tax benefits impacting the numbers. But going ahead, what is the normalized sort of a growth outlook for your earnings, and what could be the key levers to improve your ROA from current levels?
I guess in terms of the ROA, we've already seen a sizable uptick in the current year from about 2.2 to it's almost 2.6 right now. In fact, next year, what we expect is that there is a IT transformation because of which the cost will start kicking in from FY27. So there, in terms of that, in fact, cost to income might slightly go up, which might impact our ROA. But otherwise, we still continue to have a strong ROA. We expect it to be about 2.4, which was the guidance last year. We continue to have the same guidance. And in terms of our profitability also, if you see, barring, excluding the impact of the DTA and the one-time income tax refund that we have accounted for, then also our profit continues to grow at 20%. So if I remove that 46 crore one-time impact of DTA and the 13.5 crore, which is a one-time impact of our income tax refund, still, barring those two also, the profit has grown at around 20%. So with a strong NIM of 3.75 plus and a good credit cost, I think next year also we can expect a strong performance in terms of a profitability growth.
Okay, so that is also sounding good. So from what I'm gathering from this conversation, Mr. Iyer, your forward-looking guidance has been maintained where it was at for the FY26 levels, and you're optimistic going ahead. You've spoken to us about your profit guidance, your NIMs, your spreads. If you could just give us an overall understanding on where are you seeing the net interest income number, any visibility on that front?
See, we have always worked on the NIM figure of 3.75. And we'll continue to do that. Of course, the figures might change depending on, if there's a rate cut or a rate increase, those things might have an impact. But we will at least maintain a NIM of 3.75 and a spread of 2.75 plus. So that is the guidance I can give. Otherwise, if there is a rate cut or a rate increase, we will accordingly pass on because now almost entire portfolio is on floating rate. And an equivalent rate will pass on for our existing customers. But having said that, if this continues, then I think we can have a increase of a similar 15 to 18%. Rates remaining stable for the coming year also, FY27.
All right, and we look forward to that. But with this, Mr. Iyer, we let you go. So good having you on the channel today.
Thank you so much. Thank you so much.
All right, so that was the management of CanFin Homes talking to us about the growth outlook going ahead. But time now to slip into a very short break. Don't go anywhere. We'll be right back on the other side.